Hey guys, so we are trying out some new camera equipment here today. I hope you guys like this. We've got a whole bunch of different things going on to improve the audio quality, to improve just the general experience that you get with our videos here. One of the things that I've talked about now extensively over the past, quite frankly, even the past couple of years is the risk, the concentration risk that we are seeing in just a few stocks. And I wanted to look at it in a different way today through the lens of ETFs. I remember getting into the world of ETFs when I was doing an apprenticeship at UBS. Gosh, long time ago. And ETFs were kind of a new thing at that point, obviously. And it was all good and well, but what's happened over the past decade, particularly the past few years, is we're seeing really panic buying and by the part of ETFs because of inflows into just a few ETFs. So let me just kind of walk you through this and give you a bit of a different perspective. If you just type in largest ETFs into Google, which is literally what I did here. Oh, you know what? I need to change my picture here. New technology. So what I did here is I just typed in largest ETFs into Google, and what you can come up with is you can see the SPY, of course, is a large one, the iShares, IVV, the Vanguard Total Stock Market, blah 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 blah, NASDAQ 100, and you can go down the thing, and you can more or less see, and you can imagine that a lot of these, probably all of the top few here, have as their major holdings have Microsoft, Google, Apple, and a couple of the other suspects. So just to give you a very simple idea, let's have a look at Vanguard Total Stock Market ETF. And we go down here. Let me see if I can get the holdings here for this so you guys can see this holdings. All right. And you can see Microsoft and Apple, and this makes sense, of course. These are massive stocks, right? I think it's Microsoft and Apple make up 10% of the S&P right now. That is huge. And so the point I'm trying to make is that aside from the charts going vertical, and I'll go back to that in a minute. In fact, let's do it right now. This is the weekly chart of Microsoft. It has nothing to do with fundamentals anymore. Yes, there's a growth story, and that's good. And I like these companies, the Apples and the Microsofts. I keep saying that. But I just want to make sure people understand the risk of chasing this stuff right now. When people stop looking at these as growth stocks, even temporarily, there's such a small exit window or exit door for all these people to have to de-risk their portfolio, all these ETFs. So I think it's a major risk. It's probably the largest risk out there from a structural perspective, not a fundamental perspective, right? Just a structural perspective in the market. And I just want you to think about that. So if you don't, if you don't think these charts are steep, or you don't, that's one thing. But at least then look at this. Now here's where it gets really crazy. I'm an astute reader of the Wall Street Journal, and so one of the things that I tweeted out yesterday is this chart from Wall Street Journal. It originally comes from RBC Capital Markets, and what's really funny, or it's actually scary is the better term, is that you can see that Microsoft and Alphabet, Visa and Apple and Cisco and some other ones in there, they are also the largest holdings, or the most common holdings of things like ESG funds. These are like, environmental, social, and I think governments, like, kind of like make you feel good kind of funds. And even if Microsoft and these things belong in there, technically, it's all the same trade, right? So you can't. It's basically become almost impossible to diversify among different ETFs. So I'd love some comments down below. If you have questions, I'm happy to do. I would like to go sort of like I'm on a multi-video thing and have conversations. Maybe we'll do a webinar or two on this kind of stuff as well. In the coming weeks, but I just want people to understand the risks of it. Just quickly go back to Microsoft. Here's the weekly chart. Here is the Apple weekly chart. Let me quickly bring that up. Again, this is just for perspective, so you can see what these stocks are doing. There's indiscriminate buying, and it's not necessarily due to the fundamentals. It's due to the structural, what's going on in ETFs, right? Inflows have to go into those few stocks. Anyway, guys, I think we'll leave it at this here. And if you guys have any questions or comments, again, like I said, leave them down below. We might do a special webinar on this and give you some more research, and I'll I would like to also offer how you can diversify from this. By the way, this is basically what we're seeing, in my opinion, is a passive investing bubble of epic proportions. I have nothing against passive investing, but it's become bubbly, and you can see by all the stuff I just mentioned. So I think active management will come back to at least some extent. And I think a lot of people are going to get caught flat-footed, particularly people that are now late to the indexing game. By the way, a lot of hedge funds have even turned into the indexing game. So it's to me, it's a classic late stage phenomena of what's going on in a rampant bull market. So anyway, I hope this makes sense, folks. Hope it was helpful. Again, help us spread the word for the channel, and I will talk to you guys soon.